Hi everyone, I'm Brandon Averill, one of the partners at AWM, where we advise people in creating multi-generational flourishing families so that we can solve that shirt sleeves to shirt sleeves financial epidemic. And this is a front row seat with AWM's Chief Investment Officer, Justin Dyer, and myself, as we discuss some of our clients' most pressing financial questions. This is AWM Insights, and let's dive right in. Well, Justin, we're back, and we're going to take a little break from our little series here on the fundamentals. We're going to get back to the fundamentals in this conversation. I can almost guarantee that.
Oh, but we'll touch on fundamentals in this one, though, too. I mean, we can never get away from those.
Guarantee on a financial podcast, but that is we'll definitely get back into that. But we're going to take a special break today. This was a requested topic, not surprisingly, but we keep getting the question, how do the unfortunate recent events that are happening in Ukraine and with Russia, how do they impact my portfolio? Should I be thinking about making some changes? What's going on? I think most people actually know the answer to this question, but there's still some comfort in revisiting this topic. So, let's jump right in, Justin. I would love to, just touch on the fundamentals here. How are we thinking about it, when something like this happens?
Yeah, and let me just address too, right at the outset, what you said, where I think a lot of people inherently know what the answer to this question is. If they don't, hopefully this is really helpful. But we're going to go back to core principles, to the fundamentals, kind of like I was alluding to in that comment. Obviously, with respect in the context of what's going on in the existing environment and current market environment. But it's important to do that. We always go back to core principles and fundamentals a lot here and say, hey, it goes back to long-term focus and things like that. And, I'd say that tongue in cheek, but it's important to underscore the why. And it's not unique to what we do. It's not unique to investing. It's not unique to financial planning, whatever you want to label the broad subject area that we cover. Money, let's call it. It applies to your diet. It applies to working out. It applies to the corporate world. Some of the best executives around go back each and every quarter or annually, whatever it may be, to kind of the fundamental principles of what it is, what it means to be running a business, right? They have maybe their executive coach as well. And it's just kind of a trait of human nature. So it's healthy to ask questions like this, but it's also okay as well if the answer is the same. Now, and it's important to continue to ask questions and make sure the answer is the same, because there are periods of time where maybe the answer is different, few and far between, that's for sure. But let me just underscore that, and then can kind of jump into the topic and the fundamentals.
And I think that's maybe even a good place to start is with one of the ultimate fundamentals. I think the emotion, right, takes over when you see markets correct to an event like what's happening in Ukraine. But that's a healthy part of the market. It's tough to deal with. Let's acknowledge that, right? Like nobody's immune from watching a portfolio adjust to new information. But what we know is that if markets didn't adjust to that new information, that's when we actually really have a problem. And so I think the world, the markets, et cetera, as this situation continues to develop, markets are going to fluctuate with new information that's coming about. And I think that's also what makes it so hard to predict the short term. And really, nobody should be predicting the short term because we don't know what's going to happen. We don't know what's going to happen largely in the future, but we certainly don't know how things are going to unfold in the really short term.
Yeah. And it's good to go back to this concept of risk too. So risk, we always say risk and return are related. Well, that is exactly related to what you're saying, where if markets only went up and to the right, as recent history has kind of led some people to believe, really since the COVID correction and the recovery out of that, whether it be crypto or meme stocks or the market in general, it did breed a little bit of complacency. Oh, hey, investing is easy, and crypto's going to solve all these incredible problems. And I'm saying that also tongue in cheek, just to say, and I know a lot of people probably should at least understand our viewpoint on crypto is an interesting technology and whatnot, but there was a little bit of hype going on in speculation amongst other parts of the market, but risk and return are related. A correction, whatever the driver of what that correction is a healthy part of the market. You shouldn't expect higher rates of return than holding safe investments like, let's say, cash or US government bonds. You shouldn't expect a higher rate of return than those investment vehicles if risk were not a part of the equation. And geopolitical risk is a very, very real part of the equation. The other important thing, and then I'll pause and let Brandon, you run with it too, is no two historical events are the same. And almost by definition, and this really, I think, is an often very overlooked fact when it comes to people who try and time the market or talk about investing and, hey, where should I invest now? Or, is the market going to crash this year? Kind of by definition, a market crash is a crisis. And by definition, a crisis is an unforeseen event. You wouldn't call something that, everybody got right a crisis. If everyone knew it was happening, it wouldn't be a crisis, right? So and what's going on in Ukraine is potentially or it is kind of in line with that, right? No two events are the same. Things come out of left field. Maybe we had our head in the sand, or maybe it was truly like overnight something came up, but that's part of it. That is part of it, and you just kind of have to accept that.
I think that's a great point. I love that comment. No two historical events are the same, but what we can, right, is that it rhymes, is the saying goes, right? So when we look at the past and we start to look what happened, I think the picture becomes clearer. There's a great chart put out by Dimensional Fund Advisors that goes from 1970 to roughly today, and it shows the growth of the kind of world stock market. But then it labels all the events, right? And I think what's fascinating to me when I look at something like that, we'll put a copy of this in the show notes. But even if I go to the year 2000 and right before the .com, bust, if I would have put all my money into the market at that point, 20 years later, it's when you scan back out, it's grown pretty impressively. And that would have been the worst day possible, probably, to throw your money into the market. You could say the same about 2008, right? The mortgage crisis that hit us here in the U.S. And so I think trying to time these things when we start to look at those, I mean, there's study after study after study that shows, unfortunately, we can't time the markets, right? It just doesn't play out that way. There's too many decisions you have to get right. You have to get right when to get in. You have to get right when to get out. You have to get right when to get back in. And what we know is that these studies just continually show what you put at risk is missing those best days in the market. And those come pretty quickly after some bad days, typically. And so it's just almost impossible. I'd even argue impossible to time all that up on a consistent basis. People get lucky all the time. We hear these stories, right? That people get lucky with individual stock picking or timing this or that. But nobody has been able to consistently kind of get lucky and do that time in and time out.
Well, and an incredibly important component to add to that as well is knowing ahead of time who's going to get lucky or who's going to be good. I mean, let's give somebody the benefit of the doubt. I mean, there are a very, very small number of investors. Like, did anyone know Warren Buffett was going to be Warren Buffett early on? Warren Buffett is largely performed in line with the markets recently, and part of that may be the size of his company. But he was a great investor early on in his career. How many people? And is it worth actually even going down that route to say, hey, let's find the next Warren Buffett? No, because there's actually a higher probability game you can play when it comes to investing. And then, kind of trying to pivot back to the present day a little bit and and talking about the markets under a little bit of stress here, I also want to definitely bring into the conversation, hey, there is a free lunch, so to speak, when it comes to investing, and that really at the end of the day is diversification. Diversification is I mean, it is the tried and true tenet of investing. Over the last 2 years, let's say pre what's going on currently, and pre 2020 almost, as the markets have had a rockier start to the year, even before what's going on in Ukraine. The 2021, or excuse me, 2020, 2021, a lot of the kind of COVID inflated market movement makes you question diversification. Hey, no, you actually outperform in the top 5 stocks, or you should put a substantial amount of your money in crypto because it's going to double or triple or whatever the case may be. And it's just, there's a complacency that potentially sets in, and it makes sense, right? I mean, we only can look back and see how things have performed and say, well, wow, I wish I would have done that. And so I don't want to hold 13,000 different stocks and have global diversification. But you do when it matters. And right now is not, it is a small example of that. Markets haven't corrected substantially, unless your portfolio is all in Russian stocks. And where we take that I guess question is how we should be diversified is, okay, we should be globally diversified. Yeah, at times we're going to hold markets that are not performing as well as, say, the US market has over the last few years. But guess what? There was a 10-year period in the first decade of this century where the US market was flat. For a 10-year period, US market was flat, largely because of the great financial crisis, but we didn't know that ahead of time. Now, fast forward, US market has done incredibly well. US and emerging, not so much. They've still performed positively, but haven't performed as well. And you just have to accept that because of the power that practice actually produces in times of stress. And that is when it matters most. It is so much easier, going back to the behavioral finance comment, it is so much easier to just watch your portfolio rise in value kind of year over year and see good returns and all, and be comfortable with that. Even if you're like, oh yeah, I get maybe valuations are higher, or there's some weird, the economy is flooded with liquidity, whatever the case may be. It's far easier to convince yourself to say, oh yeah, that makes sense. I'm good with that. That's great. Obviously, we're kind of in this to earn money on our money, but markets will correct. It is a healthy function. It has to happen for, again, that higher expected return. And when that happens, the emotional reaction is so much different than it is on the flip side. We don't have a symmetrical reaction to gains versus losses, and having diversification in place for that crisis event that is kind of, again, by definition unpredictable, it saves you. It allows you to stay invested. Hopefully, it allows you to continue to ride out of it and have that long-term compounding effect on your wealth and multi-generational wealth as well. So, sorry, I went on a little bit of a rant there, but
no, I think it was a lot of great points there, and I think it, as you were talking, it reminded me of also the reminder that we are talking to long-term investors here, people that have taken the time and the work with their advisors to put a proper financial structure in place. Unfortunately, there's a lot of people that, if you have invested money that you need over the next year in the equity markets, yeah, I'd be pretty panicked right now, because, you're exposing yourself to complete uncertainty. And so kind of coming back to the last fundamental is that, if you haven't taken the time to identify your priorities, the advisors you work with haven't taken those and built a custom individualized portfolio for you, then yeah, I'd be nervous. I'd be pretty nervous if you're in one of those situations where your advisor just came in and did the little 10, I'm going to click and get your risk tolerance, and I'm going to throw you in an 80-20 portfolio. I'd I'd probably be a little nervous as well. So I think at the end of the day, we're talking to long-term investors because we know that is what provides the greatest outcomes. And so just, I guess I would encourage everybody to think through that. This all comes back to those fundamentals, risk and return being related. The most important part of your investment portfolio is the financial structure that you put into place. And then I would say the other part of this is, we talked a couple episodes ago about, do I do this alone or do I do it with an advisor? This is an emotional time, right? We're in a point in the world where some very negative stuff's happening geopolitically, and that's tough to deal with for most people. And if you struggle with those emotions, you probably want to lean on somebody that has a developed skill set, has gone through the training to remove that emotion from the process. And if you can find that in an advisor, a lot of times that just makes them absolutely worth their weight in gold. So we hope this has been helpful. Hopefully during this time of uncertainty, you have a little bit better idea of how markets work, that this is healthy, that markets do retreat during tough times like this. When you scan out, there will be better days ahead, right? Unless capitalism completely folds, we're going to see our money grow over time. And that's really what everybody here is in the game for. So as we close out, just a reminder again, shoot me a text. We'd love to keep in touch with you. We're going to be giving away some stuff via this text message as well. So the phone number for the text is 602-704-5574. If you shoot over, the word insights or that little light bulb emoji, we'll get some cool stuff out to you. We're going to start giving out some swag on that phone number as well. So we look forward to hearing from you. I'll say it again one more time, but 602-704-5574. We look forward to staying in touch with you. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.